Okay, so just a quick question from Noel, who is asking for some insight on the correlation between bonds and currencies. Now, there's two main reasons for bonds and currencies being closely correlated. The first one is interest rates. And as we can see on the chart in front of us, we can see the Australian 1-year government bond yield in purple, and we can see the Australian cash rate, so the Australian base interest rate, in orange. And as we can see, both of these are very highly correlated with one another. Now, the reason why we're looking at the 1 year is because that really does simply reflect just the expected yield on a bond, which is of course very closely correlated with interest rates. Now, we can look at higher durations for bonds, but the further out you go, you add what's called a term premium. And a term premium is simply the additional return expected by investors for taking on the risk of holding a bond for a longer period of time. And of course, that comes with additional risks such as the risk of default. But as we can see, even here, looking at the 10-year, there is a very close correlation between the two. Now, likewise, with a very close correlation between interest rates and yields on bonds, there's a very strong correlation between interest rates and currencies. And a big reason for that is because, of course, on a currency, you are paid a carry. So every time at market rollover, you receive a little bit of interest, which is the equivalent to holding that currency overnight. Now, for that reason, you have a lot of interest in a market strategy known as carry trades, which is where you hold a high interest rate currency against a low interest rate currency, and effectively you're paid the interest, so a swap of just simply holding that currency overnight. So for that reason, the higher the interest rate is, the more of a swap you're going to receive on a currency, and that makes that currency more attractive to hold. And likewise, for that reason, again, going back to swap trades, if you have a low interest rate on a currency, that currency is more attractive as a funding currency. So a currency you can look to short simply in order to buy that higher yielding currency and then benefit from the interest rate differential between the two currencies. Now, the second reason why there is a correlation between bonds and currencies is simply because of, in order to buy a bond from another country, you firstly have to buy that foreign currency to buy that country's bond. So for example, if an Australian bond has a higher yield than a domestic bond or a bond in your own country, then Australian bonds are going to appeal to you more than domestic bonds are because they'll return a higher yield. So for that reason, what you're going to have to do is you're going to have to buy Australian bonds by firstly buying Australian currency, which means selling your own currency, buying Australian currency, and then using that to purchase bonds. So for that reason, if bonds in Australia, in this example, are more attractive, then there's also going to be increased demand for Australian dollars because investors are going to have to buy Australian dollars before they can buy Australian bonds.